At Fidelity, we have been listening to what clients' needs are. For instance, clients want income, but want so with lower volatility and lower drawdowns. As such, we have designed, or we have launched, and we've been managing the global multi-asset income strategy for around 5 years now. And the key objectives of this strategy are an attractive and sustainable level of income, but also doing so with low volatility and low drawdowns. Essentially taking a total return approach to income investing. And on the back of the success of GMI, the Global Multi-Asset Income Strategy, we have also launched regional strategies, Asia-Pac Multi-Asset Growth and Income Strategy, and a Greater China Multi-Asset Growth and Income Strategy, which again focus on growth, income, and stability. Essentially, when we talk about multi-layered approach, we think of 3 layers. The first layer is asset allocation. So we try to identify where we are in the economic cycle and then rotate the portfolio and emphasize the areas that we think are going to do better, whether it's in equities, fixed income, or alternatives. The second layer is the building blocks we use, the strategies we use to populate our asset allocation. And lastly, the third layer, this is essentially overlays hedges to dampen down volatility and create a more stable environment for our strategies. I think a key competitive advantage we have at Fidelity is the number of building blocks at our disposal. What do I mean by building blocks? We've got a lot of strategies in the equity space, large caps, mid caps, value, growth, in fixed income, investment grade, hard currency bonds, local currency bonds, inflation-linked bonds. And in the multi-asset team, we can use all these different building blocks to essentially navigate volatile markets, and combining our asset allocation expertise with a proven track record of these underlying building blocks. Let me give you an example of how we try to think of unintended consequences in the portfolio and how we manage them. And let me take you back to the summer of 2016. In the UK, I was actually in the UK then, that was before I moved to Asia, and we had the Brexit referendum. Now, the market was pricing in Remain. We looked at that and we got uncomfortable with a roughly 10% exposure we had in GBP, the GBP currency. And as a result, we decided to reduce that to almost 0%, because we thought that the currency, the UK currency, would take the biggest hit should there be an unexpected Brexit. As we all know, Brexit materialized, and the day after Brexit, we saw the currency plunge up to 30% intraday. One of the key differentiators for the Global Multi-Asset Income Strategy is its focus in Asia. Historically, we've had around 20 to 30% exposure to Asia. Now, G stands for global. It would not be a global strategy if it did not have exposure to Asia. And why do we like Asia? If I look on the equity space, we have seen a lot more companies embrace a dividend-paying culture. And within fixed income, we have seen a lot more depth and breadth in the fixed income universe. Now, these are outcome-focused funds to meet clients' needs, as I mentioned earlier, and as such, they should be all-weather funds. Why it is particularly important today to invest in such strategies is because we have seen a change in the volatility regime. We have seen volatility rise in recent months. As such, taking a total return approach to investing for income, for instance, we think is very, very important. And if I look at performance for the Global Multi-Asset Income Strategy, it has been strong in absolute terms, and more importantly, it has been strong in risk-adjusted terms. And this is where the focus on drawdowns and volatility comes to play.